Hello class and welcome to our 11th lecture series on financial accounting or principles of accounting, and I am your instructor Jamal Haider. So today we are starting a new chapter and we will be starting to analyze how we account for the inventory, right? So recall our discussion regarding the inventory. So when we talk about in assets and different kind of questions, illustrations, we talked about when you sell, there are going to be two entry. One is your finished goods decreases and one is on the production side. So you decrease your inventory as well. So there's going to be two effect. One is that the goods are sold and you need to less it from your current stock or your inventory. Okay, so our first learning objective is show how to account for inventory. Here we go. So so when merchandisers or sellers or producers or shop owners or retailers, so they have two accounts that service industries they don't have, because in service industry you don't have hard product. So in merchandiser, which means you order raw material, you process the raw material, and then you make a finished goods, and then you sell it. So there is a difference between service companies income statement and the difference between those who are production oriented companies or merchandising company. So you see here the income statement of service companies, simple: revenue minus all the expenses, including income tax, depreciation, we have net income. But for merchandising, it's a different story. See, sales minus cost of goods sold, and then we get gross profit, and then we less salaries, depreciation, income taxes, then we have net loss. So we are doing this, or we are learning this chapter with perspective of merchandising company, because inventory is only present in merchandising company. So if you see banks, hospital, teaching, so they don't have inventory. They have inventories as supplies, furniture, right, fixtures, but not because they are not selling. They are selling their services. So like salons, beauty makeups, beauty salons, this kind of stuff. So in merchandiser income statement, we have extra account, which is cost of goods sold. And similarly, if income statement is not same, then of course balance sheet is not going to be the same as well, because in balance sheet of service industry, like real estate or they have cash, short-term investments, accounts receivable, prepaid expenses. But you see in merchandising company, cash, short-term investment, and inventory. So remember, it is also liquid asset. Why? Because it is under current assets, and current assets definition is its usage is for less than 1 year, right? So inventory, similarly, you make the inventory with perspective that you can sell it in a year, right? So that's why it is in a current assets. Plus it is liquid, yes, but not liquid as account receivable, not liquid as cash or cash equivalents, right? Let's move forward. So so assume we have illustration here how we are going to basically we are learning what is the difference between when we sell services, when we sell the products, physical products. So assume you have a family dollar store in corporation which has stock of 300 towels that cost 3 each. So in your inventory, you have 300 towels, right? In your balance sheet, it is showing, or in your stock, it is showing you have 300 towels, and the cost of those towels 3 each. So Family Dollar stores makes each towel up to 2 and sells 200 of the towels for 5 each. So it means they earn $2 profit on each towel. So their sale price is 5. So how it is going to affect the financial statements of Family Dollar store? Number one, sale happen. Of course, it will be increasing our sales. How much? So you multiply the sold units with the sale price, $5. See, right? So cost of goods sold are what you have sold, how much you have sold, what is the cost of those one. So pay close attention to the name, cost of goods sold. So some students, they made a mistake, they multiply the 3 with the 300. These are your manufactured goods or you have in your inventory, right? Not in your sales. So you didn't sell 300, right? You sell only 200. So that's why cost of goods sold, the goods that you have sold 200, what it cost you? $3 each. So you multiply with 3. So this is our 400 gross profit. So remember, you have 300 towels in your income statement. So when you sold, it means it will be less from here. So 300 towels in quantity. So sorry, 300 towel, it was previously before 900 because 300 multiplied by 3, and now we have left 100. So it means the sales in merchandising company affect both income statement and balance sheet. In income statement, it is affecting two accounts, sales and cost of goods sold. In balance sheet, it is affecting the inventory item under account receivable, under current assets, right? So similarly, it has two entries as well. So like I just told you, so the cost of inventory shifts from assets to expenses, right? It cost you $3 each towel. So when you sell it, then that cost of inventory become your expense, cost of goods sold, right? So you need to deduct from the inventory account and take it to the income statement. So cost of inventory on hand and the cost of inventory that has been sold. So cost of inventory on hand, we have 900, we have sold what 600, 200 multiplied by 3. So that will become our cost of goods sold. Remaining will still be showing on balance sheet as an inventory. So there's a difference. Of course, there is a difference because sale price is different, cost price is different. So in order to calculate cost of goods sold, remember, you need to multiply the number of units sold, not the number of units a company have. Okay, so many students make a mistake in the formula for calculating the cost of goods sold. They multiply with the cost per unit with the total number of units manufactured or total number of units the company have as in their inventory. So you need to be sure that, okay, in order to calculate cost of goods sold, we must multiply number of units sold with the cost of that inventory. Similarly, so the inventory based on the cost on hand. So similarly, if you want to find out the inventory value, what should be written on the balance sheet? So what you have left, inventory multiplied by the cost of the inventory, right? Simple. So only thing that should you should keep in your mind is the cost of goods sold. So you can just see that cost goods sold. So number of goods sold multiplied by its cost. Simple, right? So don't get confused. So sale price versus cost of inventory. So number of units of inventory, it is determined from accounting records. So how we know that how many numbers of units we have. So we can see accounting records like 100 hours left. You can have a physical count at the year end or the month end or the weekend, depends on your company policy. So consigned goods does not include those held for another company. So If the order is still, in process, so you already deducted. So in the system or in your accounting, because you sold the 200 towels, so now that 200 towels, whether it is in your possession right now, but ownership is not yours, ownership have been transferred. So all those units, whether it is in your company premises or whether it is, the possession is in your, because you also are responsible for transport, so that shouldn't be the part of inventory, whether it is with you or not, because ownership is transferred, right? Similarly, in transit goods, if the shipping terms of that, as soon as the goods are transferred from the company premises, now ownership is transferred, then you can deduct the inventory. If shipping terms are that you are responsible for delivery charges and you are responsible to, deliver the goods on customer's doorstep. So until the process, ownership is not transferred, ownership is still with you, you still have the inventory. When the goods is being transferred, then you decrease the inventory, right? So it's just, business law terminology. So let's just go through that. So similarly, FOB on board, FOB on FOB shipping point, FOB destination. So it means free on board. So when FOB shipping point, at the point where goods leave the seller's shipping dock. Simple. As soon as the goods leave from company premises or whatever written in the document, if we are shipping to the, foreign country, as soon as goods leave from our shipping port or shipping dock, ownership is transferred and company is entitled to consider that sales or and decrease the inventory. FOB destination means the ownership is not transferred until customer got the goods. Whenever customer got the goods, he signed it, okay, I have received, then you are entitled to consider it as a sale and reduce your inventory on the balance sheet. Now, the accounting for inventory in perpetual system, or what kind of system in which we use different kind of, what kind of systems for recording inventory. So there are two systems for recording inventory. One is perpetual, one is periodic. So in perpetual accounting system, so it can be used for all kinds of goods, whether you are selling pen, cards, whatever. So it depends on, keep on running records of goods bought, sold on hand. So it means you are making the goods, you are selling the goods, so everything is like on perpetual basis, on running basis. So in this case, inventory should be counted at least once a year. You can count on daily basis or monthly basis or weekly basis or 6 monthly or quarterly or annually, but at least once you can count the inventory. Okay, how many inventory left? So the thing is that in which sales and purchase is around the clock, right? Periodic system. This is used for an inexpensive goods, and you do not keep a running record of all the goods bought and sold. So you ordered in advance, order came to your company, and then you produce the goods, and then it's a sale season, you sell the goods. Similarly, in that system as well, inventory is counting at least once a year. It depends on you as well. You want to count at the end of the day, month, quarter, it's up to you, right? So how perpetual system works?